In 2025, Apple's digital services generated $109 billion, a sum that out-earns the total annual revenue of most companies on the Fortune 50 list. Many investors and consumers still identify the company primarily by the physical devices it manufactures, but the hardware business is heavy. It requires sourcing raw materials, managing global supply chains, and paying for the constant shipment of physical goods across the world. These physical constraints mean Apple keeps about a 35% gross margin on its devices. Every unit sold carries the weight of labor and materials. As the global smartphone market reaches a plateau, relying on a model with fixed physical costs and limited margins becomes a precarious long-term strategy for growth. Apple leveraged its footprint of over 2 billion active devices to change its underlying economic model. Instead, they moved toward a powerful new model designed to generate recurring revenue from their existing users indefinitely. The strategy is to act as a landlord for digital real estate, charging a fee for the apps, storage, and services that run on the hardware. The iPhone functions as a gateway into a proprietary digital economy that Apple owns and manages. The App Store serves as a digital toll booth. Apple collects a significant percentage of all third-party software sales without having to build or maintain the apps themselves. iCloud provides a steady stream of monthly income by charging users to store their personal data and photos on Apple's servers. AppleCare then monetizes the owner's interest in protecting a premium, fragile device, providing high-margin insurance for the hardware. This chart illustrates the financial disparity. While physical devices yield a 35% margin, services generate a 70% margin. This gap exists because digital services have near-zero marginal costs, allowing profit to scale infinitely alongside revenue. This high-efficiency profit conversion helped drive Apple's total net profit to $112 billion in 2025. The hardware effectively places a profitable service platform in the user's hand, designed to extract digital rent month after month. To keep this revenue flowing, Apple creates switching costs, barriers that make it difficult for a user to leave for a competing brand. Researcher Cory Doctorow notes that Apple ensures its own products work together perfectly, while often limiting the functionality of third-party competitors. Users who try to switch to another platform face the loss of their purchased app library and the disruption of their synchronized cloud backups. The iMessage system uses visual cues, like the green bubble, to create social pressure, making the technical choice to switch a social burden as well. The walled garden operates as a deliberate friction point, ensuring that moving to another brand is an exhausting experience. Other tech giants follow different paths. Google focuses on an open model, monetizing user data through advertising across millions of different devices. Microsoft integrates its software into the essential workflows of global corporations, ensuring its tools are required for business. Apple operates on a different logic. They lead with privacy and design to attract the individual user, then use software synergy to secure the perimeter. While rivals rely on broad access or corporate necessity, Apple wins by keeping the consumer in a self-reinforcing, highly profitable loop. Apple has evolved into a global subscription powerhouse, dwarfing the traditional manufacturing models of the past. This shift demonstrates the power of building a self-reinforcing ecosystem rather than relying on a standalone product. Stability comes from ensuring that multiple products provide more value when used together than they ever could apart. Spending $1,000 on a new iPhone effectively renews a high-margin subscription to a user's digital life.